Hi, welcome to the DFA video blogs. Today I want to discuss who actually benefits from high house prices. Most would accept that house prices in the major Australian centres are too high. Whether you use a measure of price to income, loan value to income, or price to GDP, they're all above long-term trends. Indeed, in Sydney and Melbourne, they are arguably more than 30% higher than they should be. Ultra-low interest rates currently make large loans affordable for many households, yet overall household debt is as high as it has ever been, and mortgage stress, even at these low interest rates, is really quite high. Banking regulators are concerned about systemic risks from over-generous underwriting criteria, and they have been lifting capital ratios to try to improve financial stability, with a focus on the fast-growing investment sector. In many countries around the world, house prices are also high. So from New Zealand to the UK, regulators are taking steps to try to limit systemic risks. These rises are partly being driven by global movements of capital, ultra-low interest rates, and quantitative easing. However, let's think about who benefits from high and rising prices. Well, first, anyone who currently holds property, and that is 2/3 of all households in Australia, will like the on-paper capital gains. This flows through to become an important element in building future wealth. And in addition, refinancing is up currently, and we see some households crystallising some of the on-paper gains for holidays, a new car, or other purposes, stimulating retail activity. A recent RBA research paper suggests that low-income households have a higher propensity to purchase a new vehicle following a rise in housing wealth than high-income households. Those holding investment property will also enjoy tax concessions on interest and other costs, and on capital appreciation. Rising wealth generally supports the feel-good factor and consumer confidence, although currently this is a bit wonky. Higher values stimulate more transactions, which creates more momentum in a sort of virtuous circle. Now, the 1/3 of households who are not property active consist of those renting and those living with family, friends, or in other arrangements. Their confidence levels are lower, and they are not gaining from rising house prices. A relatively small proportion of these are actively seeking to buy, and they are finding the gradient becoming ever more challenging, as saving for a deposit is becoming harder, lending criteria are tightening, and income growth is slowing. We've noted previously that a rising number of first-time buyers have switched directly to the investment sector to get into the market. Generally, younger households are yet to get on the housing escalator, whilst older generations have clearly benefited from sustained house price growth. This has, in my view, the potential to become a significant intergenerational issue. But overall, the wealth effect of rising property is an umbrella which spreads widely. The sheer weight of numbers indicates that there are more winners than losers. No surprise then that many politicians will seek to bathe in the reflected glory of rising values whilst paying lip service to housing affordability issues. And there are other winners too. For states where property stamp duty exists, the larger the transaction value and volume, the higher the income. For example, in New South Wales, in January and February this year, nearly $1 billion was added to coffers thanks to this tax. And the state is well on track to achieve the $6.1 billion of stamp duty forecast in the 2014-15 budget papers. The higher the price, the larger the income. The tax take funds locally provided services, so ultimately residents benefit. The banks also benefit because rising house prices give them the capacity to lend larger loans, which in turn allows house prices to run higher again. They've benefited from relatively benign capital requirements and funding, thus growing their balance sheet and shareholder returns. Whilst recent returns have been pretty impressive, future returns may be lower thanks to changes in capital ratios, and especially if housing lending moderates. On the other hand, their appetite to lend to productive businesses and commercial sectors is tempered by higher risks and more demanding capital requirements. The relative priority of debt to housing, as opposed to productive lending to business, is an important issue, and whilst higher house prices can flow through to real economic growth, it is mostly illusory. Finally, building companies can benefit from land banks that they hold and development projects despite high local authority charges. We also note that some banks are now winding back their willingness to lend to the construction industry because of potentially rising risks. The real estate sector, of course, benefits thanks to high transaction volumes and larger commissions, and mortgage brokers also enjoy volume and transaction-related income. And even retailers, with a focus on home furnishings and fittings, are buoyant. So standing back, almost everyone appears to benefit from higher prices. But is it really a free kick? Well, for as long as the music continues to play, it almost is. The question becomes, what happens if, or when, prices were to fall? Remember that during the GFC, Northern Hemisphere prices fell in some places down 40%, though since then prices in the US, Ireland and the UK have started to recover. Given our exposure to housing, there will be profound impacts on households, banks and the broader economy if values fell significantly. But underlying all this, we've moved away from seeing housing as something which provides shelter and somewhere to live, to seeing it as just another investment asset class. This is probably an irreversible process and part of the financialisation of society, given the perceived benefits to the economy and to households. But we question whether the consequences are fully understood. I'm Martin North from Digital Finance Analytics. Thanks for watching.